My name is Yonah Weiss. I work for a company called Madison Specs. We're the largest national cost segregation company. And what is cost segregation, you may ask? Well, we will get to that today. We're going to cover all the things you ever wanted to know and more about cost segregation. And also the host of a great podcast called Weiss Advice. Yes, it is a play on words and it rhymes. So check it out. Go to wherever you listen to podcasts. And let's just jump right into what is cost segregation. What is cost segregation, you may ask? What is depreciation? That's really the question you should be asking first, because that is how we're going to understand what cost segregation is. Because cost segregation is just an advanced form of depreciation. But what are the benefits of doing cost segregation? And how come I never knew about this? And why did my accountant never tell me about cost segregation? So many questions I could be asking, but I really want you guys to ask the questions. So make sure you do comment or write in and contact me afterwards. Who should be doing this? When is the best time? And what is a real estate professional? That's an important question. If you don't know what a real estate professional is, you actually may be missing out on tons of tax deductions and benefits here. We're going to do a little bit of a case study and then jump right into it. What is depreciation? Now, you may be thinking to yourself, hey, depreciation, it sounds negative. I don't like that. Well, guess what? Depreciation is just a borrowed term. It doesn't actually mean that your property is going down in value. It just means the IRS is allowing you to take a tax deduction based on the principle that your property is going down in value when it's actually not. It's actually probably going up in value, but you can actually take a write-off of that property. You can't do it all at once. You have to do it over a 39-year schedule or 27.5-year schedule for residential, and multifamily properties are considered residential from a tax perspective here. So really important to understand. Most accountants know this, and most accountants are using this, what's called the straight line depreciation method, which can allow you to take these deductions over these relatively long periods of time. But there is a tax planning technique that's called cost segregation, which allows us to accelerate depreciation of certain components in the property. It actually used to be called component depreciation, which to me, if you ask me, makes a lot more sense than cost segregation. But for whatever reason, the IRS chose that term and is sticking with it. And so cost segregation allows you to depreciate certain components of the property over 5, 7, or 15-year category, getting you bigger tax deductions in the early years of ownership. And this is essentially the benefit of cost segregation. So let's take an example, a real life example here. Let's say you buy a property for $1 million. Okay. And it depends where you're buying in the country. In California, it might just be a single family. In, who knows, out in northern Louisiana, it might be, a 20-unit property. Who knows? But you're buying this, and we always have to allocate a certain amount for the land. The national average is about 15%. So let's say we're doing that. That leaves you with $850,000 that you can take as a depreciation deduction over the course of ownership. And it doesn't depend when this property was built. It only depends on when you, the new owner, bought the property, because your 27.5 or 39 years starts the day you buy the property, not when the property was built. Unless, of course, you're the one that built it and placed it in service for the first time, in which case it would be based on when it's built and when it's placed in service. So how does this work? Let's say you're just taking regular straight line depreciation. That means that you would be taking about a $21,000 or per commercial property, or a $30,000 deduction every single year for the course of 27 or 39 years. That's great, which means if you, on this $100,000 million property, you're making about $50,000 of net operating income. Well, guess what? You just save yourself a lot of money in taxes just because the government said, take this depreciation deduction. Just subtract 30,000 from 50 and you get $20,000. That's the only amount you're going to be taxed on. So instead of being taxed on 50,000, you're only being taxed on 20,000. That's how depreciation works. And that's why depreciation is so amazing. But as a good friend of mine and very famous real estate investor, Keith Wasserman, said, cost segregation has something called bonus depreciation. And bonus depreciation is the eighth wonder of the world, because not only are you allowed to take so many deductions at a faster rate, you can actually take some of those deductions, and a lot of those deductions, all up front in the first year, getting a huge tax write-off, and we'll get into that shortly. So again, just to reiterate here, cost segregation is going to get you bigger tax deductions, more so than this straight line depreciation method is getting you, and we'll show you how that works. The way that it works is through an engineering process. So an engineer is going to come in, look at the property, and determine how much the different components of those property, and in the next slide, I'll show you what those components are, and breaking those down into different categories. And so this does not matter if you put any improvements into the property. What we're going to be looking at is the purchase itself, meaning whatever you spent on the purchase of the property, the acquisition, you're able to now break that down into its different categories. Because now we're holding by this slide, and this slide is what's going to break down those different components. Okay, that will allow you to allocate these into different categories. So let's say you buy multifamily property. In it is not just the structure that depreciates on a 27.5-year schedule, like the walls, the foundation, the windows and doors and infrastructure, but there's stuff that's called 5-year personal or tangible property, like cabinets, equipment, furniture, appliances, right? These things, we know what all these things are, right? Special purpose plumbing, vinyl floors, carpeting, anything that is non-structural. So it doesn't mean that it's actually movable, because a lot of these things may be attached, or cabinets, right? Countertops. Those things are attached to the property, but they're still considered 5-year property, meaning you can take the value of those components as a tax write-off over a 5-year period instead of lumping everything together over that 27.5-year schedule. Okay, so this is where it gets really, really, really important. Again, you're going to get sometimes 20 or 30% of the property into these faster depreciation categories, getting you much bigger deductions up front. The second category over here is called 15-year land improvements. This is anything like asphalt, concrete, fencing, landscaping, basically anything outside the property will depreciate over a 15-year period, not like land. Remember, land itself does not depreciate, but land improvements do, anything on top of that property. And so this, again, can be extremely valuable, especially like a retail property, has a huge parking lot, or even multifamily, where you're talking about, big garden style multifamilies with a lot of landscaping, a swimming pool, maybe things like that. All of that will be depreciated, the value, over a 15-year schedule. And this is going to be really important shortly when we understand how bonus depreciation works, because you can take that all up front in the first year. All right. Now, what are we doing? Just to reiterate here, we're reducing our tax liability by creating more deductions. That increases our cash flow and creates what's called the time value of money. Now, we know about this more than ever now because of inflation. We know that having more money now to invest is more important than ever, because if you are just going to pay the IRS, pay the income tax, you're going to miss out on reinvesting that money and having the compound growth or the compound interest of those investments. And something that a lot of people miss out on is because they think, what's the point of taking these deductions at a faster rate up front when I'm just going to have to pay, later on? Well, the truth is, you may not know. Maybe later on you won't have to pay those taxes. So better, and every single accountant I've ever spoken to, at least the smart ones, told me that the first thing you always want to do is try to find as many deductions and deferrals as possible. Okay. And so this is, if you don't have to pay the tax, don't. Okay, so legally, this is the right way to go. So bonus depreciation, we're going to get to that. This is really, really important, because especially nowadays. So this is a kind of an old slide here, but you see, we're not, someone think, oh, we take all these deductions up front, off anything left over. Well, no, again, if we're just taking about 20 or 30% up front, that's going to increase a lot to the first 5 years or so. But at year 6 and onwards, we still have, almost the entire amount of deductions. Again, we're just taking a little bit less over those years after that. So what's bonus depreciation? This used to be something that was 50% and increased to 100%. What this says is, once you've done a cost segregation study, now again, bonus depreciation is the same thing as cost segregation. Once you've done a cost segregation study, you're able to take any of those properties that depreciate under 20 years, like all the things I mentioned on the slides over here, 5-year, 15-year property, all of this can add up to a lot, and you can take that all up in the first year. Okay, the reason why the government introduced this in the Tax Cuts and Jobs Act, not exactly sure why, but they did it, and now we're stuck with this great benefit that has increased, the value in a lot of people's portfolios, because having more deductions allows you to reinvest more. but it is going to start to phase out. So next year is going to go down to 80% bonus, and then by 20% each year until it is entirely phased out. So this year, 2022, is the last year to take advantage of 100% bonus depreciation to get those huge lump sum deductions in the first year. And even if you don't use them, you can, meaning in the current year, you can carry forward those losses, meaning you can use them next year or any other future year. So who should be doing this? When can you do this? We're going to get to that too. This can be done by anyone. It doesn't matter what type of structure. It doesn't matter if you own the property as an individual, if you own a property with an LLC, a partnership, etc. The only one this does not apply to is someone who is not taxable. So like think about a nonprofit or a government entity. They can't take these deductions. Also, certain retirement accounts. I know a lot of people invest through retirement accounts. If you do that, you just have to know that you may not be able to take those deductions because it's already a tax shelter. So like a 401k, if you're investing through a self-directed Roth IRA or something like that, you cannot use depreciation. So probably not beneficial to do a cost segregation study, or not beneficial at all. Well, what types of properties are going to be most beneficial? Well, apartment buildings usually generally have about a 28% reallocation, meaning if you buy $1 million property, you allocate a certain amount to land, about 28% of that can be accelerated depreciation. So that would give you, I'm doing a little calculator math over here, about $238,000 of deductions, again, after we allocated land. So that's huge. That means you can take that with bonus depreciation upfront in the first year, $200,000, $250,000 deduction upfront. Other types of properties that can be done by, cannot be done on your personal residence, but can be done on single families as well. I didn't list it over here, but mobile home parks are also great things going off the chart here. So a lot of different properties we can do cost segregation on, not just limited to multifamily as some people think. What is a real estate professional? This is probably the most important thing that you will ever learn when you're learning about cost segregation, because you can get the benefits more than anyone else. And that, what I mean by that is rental property income is treated differently than your ordinary or active income. So if you have a W-2 job, that's treated as active ordinary income on your Schedule C on your tax return. If you have rental properties or real estate investments, that's going to be on your Schedule E on your tax return. And guess what? They're treated differently. Depreciation that you get from cost segregation, or even without cost segregation, depreciation is going to be hit to your Schedule E, meaning only your passive, what they call passive income, and that will allow you to deduct any of that income from those deductions. However, if you're a real estate professional, which I'm going to define in a second here with this slide, you're able to actually carry over those deductions not only to the future year, but in the current year against your active income or your spouse's income. So if only one of a spouse, you or your spouse, is a real estate professional and the other one has a W-2 job, you can use these deductions from cost segregation to offset your spouse's income as well. So how do you define a real estate professional? That you spend the majority of your time in real estate trade or business, materially participating, that's the words of the IRS here, and you have to spend at least 750 hours a year. And this is looked at on a year-by-year basis. So 750 hours a year is not a lot, but you have to be able to, if in the event of an audit, to prove that you actually did spend the time. So make sure to track those hours. So what is defined as a real property trade or business? Developing, redeveloping, constructing, reconstructing, acquiring, converting, renting, leasing, operating, managing, or brokering. And this is probably the most important one, because there are many people who are real estate brokers that automatically qualify as a real estate professional. So all you need to do is now buy rental properties and invest in real estate, and also get the benefit that comes along with being a real estate professional, which is that you can use these deductions against your active income as well, your commission or whatever your salary income as well. When is the best time to do this? You can do this at any time. It does not need to be done the first year of ownership. You can do this a look back study in a previous year property, or you can do it immediately. And most people, what they like to do is to reach out to me when they're in the due diligence stage, or when they're under contract on a property or looking to buy something, and say, hey, Yonah, can we figure out and see what we can get if we do a cost segregation study? So we don't actually do the full study. What we do is what's called a feasibility analysis, a free estimate of sorts that will allow you to see what the potential tax savings are if you do a cost segregation study. So reach out, feel free. It's a free study. I'll provide contact info at the end. And make sure to use the Q&A, guys. There's a question box, a Q&A box, and we want to make sure to get to all of your answers whether live or afterwards. So again, you can do this on the acquisition, you can do it on a renovation. And the main thing is when you're doing a renovation is you have to make sure that you place the property in service first before you do the renovations. Meaning, if it's a rental property and then at a later point you do some value add, or on some of the units of the property, a value add, that you can do both on the acquisition and on the renovations. However, if you just do a gut renovation before you start renting it, you can no longer do a cost seg on the acquisition itself, meaning this money spent on buying the property, only on the money spent on the renovations. That's an important thing a lot of people miss when we're talking about renovation study. And again, you can do this on a look back, meaning a property that you purchased in a previous tax year. We don't need to amend your tax returns. All you need to do is fill a form. It's called 3115. It's a change of accounting method form. So let's get into a little bit of a case study here, if we will. It's a multifamily property. This was purchased in North Carolina, about 32 units, not about, exactly 32 units. And this was a $1.75 million purchase, and first multifamily purchase after many single families, that this person wanted to do a 1031 exchange and failed that 1031 exchange, and instead had a big capital gain tax bill. And we'll see in a second why that's so important. So without cost segregation, the normal depreciation deduction would be about $54,000. Again, we're taking that $1.75 million, taking off a certain amount for land, and then dividing that by 27.5. That's where you get this $54,000 number. And that's exactly what we did. Took off 15% for land, and then divided, after doing the cost segregation study, the rest of the property into its respective categories. So about, 72%, the majority is always going to be in the building. Remember, the structure, the building, foundation, roof, windows, doors, that's where the main value of every property is. Okay. But the land improvements, that's a 15-year property, landscaping, pavement, there's a lot of value there. 8% of the total value. And then again, the 5-year property, close to $300,000, 20% of the property here. What that got him is about a $421,000 tax write-off in the first year. Again, this is bonus depreciation, adding up these two here. So bonus depreciation not only wiped out his entire taxable income tax, but also the capital gain tax that he had to pay because of the sale of those single families. So really great story over here, and just kind of shows you the power of even a smaller property. Guess what? On this $1.75 million, how much money do you think he actually put down as a down payment? I would guess it would be somewhere between about $300,000 to $400,000, right? If you're putting about 20 to 30% down payment on the property. Well, you can still, that doesn't matter. It doesn't change anything from depreciation, meaning you can take the entire depreciation of the property based on the purchase price, not based on how much money you actually put in. Okay, so that's a really important thing a lot of people don't think about. Who should be doing this is really only someone who is qualified, and because this is taken directly from the cost segregation audit techniques guide, that needs to be done with someone with experience and expertise in engineering, in construction engineering, and there is a lot that goes into preparing a real cost, what's called a quality cost segregation study. There's a whole numbering system, a whole nomenclature referring to the listings of the tax code, etc. And that's pretty much it. This is really covering it. The one thing I didn't include here in the slides here is, a disclaimer that this is not tax advice. This is just education. So make sure to refer to your tax or legal counsel before doing anything your own. And feel free, if you do have any questions, reach out to me on LinkedIn, or you can contact me at yonahweiss.com. But if we do have any questions, now would be the time.
I have a couple of questions, So
Yes.
yeah, so I think there are a couple of things like CARES Act on what are the implications on tax side. So would you explain on that part? And also,
Other implications on the tax side.
yeah,
Meaning on the cost segregation itself. So yeah, the cost segregation it's an income tax deduction, which allows you to reduce your income tax liability, but is only limited to your rental property income, meaning any passive income that you have, unless you are a real estate professional, in which case you can then use those deductions against your active income as well. However, another implication is that when you sell a property, you're going to be subject to what's called depreciation recapture tax. Recapture tax means that when you sell a property, you're going to be taxed on the amount of depreciation taken. Okay. So the amount of depreciation taken, you're going to be taxed on that. It does not mean that you pay back that tax. Does not mean that you pay back that depreciation, but it does mean you're going to be taxed on that. And unless you do 1031 exchange to defer that tax, you're going to be subject to that upon the sale.
Any inputs on energy credits, 179D, 45L energy credits?
Yeah, so those are really, something different than cost segregation per se.
Yeah.
But the 179D for energy credits or 45L, those are things that you can, if you do like put in solar panels into your property or other types of LED lighting and things like that that are better, more beneficial, you can take those as tax deductions. Okay, so it's not depreciation. We're not going to be depreciating those assets or those components. You can actually take them as tax credits or tax deductions.
So any parts or any areas where we cannot implement cost segregation?
So land, again, if you buy raw land, you cannot do cost segregation on that. You can't do it on your personal residence. You cannot do cost segregation. However, if you're like house hacking, as they say, like living in one unit, renting out the others, you can do cost segregation on the rental units itself. What other ways it will not apply is probably if you are planning on selling within the first year or two of ownership. So getting these benefits are great, but kind of taking them and then being able to use them is a whole different story. Meaning, if you are planning on selling the property in a short period of time, the benefit of getting those deductions is such a short period of time that you're going to have that tax on the sale, which is probably going to wash out the benefits of the of those deductions in the first place.